So good morning everyone, especially to our professor, Sir Arturo Bedricosa. I am Mary Jean Quiñanola and I will be the one reporting part 1 of chapter 10, which is about mortgage markets. Later on, Jean Irene Marita Cata will discuss the next part of the chapter. Chapter 8 discussed the money markets, the markets for short-term funds and capital markets, the markets for long-term funds, bonds, equity. The first section of this chapter discusses the mortgage markets, where borrowers, individual businesses, and governments can obtain long-term collateralized loans. From one perspective, the mortgage markets from a subcategory of the capital markets because mortgages involve long-term funds, but the mortgage markets differ from the stock and bond markets in a number of ways. First, the usual borrowers in the capital markets are businesses and government entities, whereas the usual borrowers in the mortgage markets are individuals. Second, mortgage loans are made for varying amounts and maturities, depending on the borrower's needs, features that cause problems for developing a secondary market. So, what are mortgages? Mortgages are long-term loans secured by real estate. Both individuals and businesses obtain mortgages loans to finance real estate purchases. A mortgage is a type of loan that people or business use to buy a house or other property. It's a long-term loan, which means it takes many years to pay back, usually 15 to 30 years. The property, like a house or building, is used as security for the loan. This means if the person who borrowed the money can't pay it back, the bank can take the property and sell it to get their money back. For example, let's say a family wants to buy a house that costs of 1 million pesos, but they don't have enough money. They go to the bank and apply for a mortgage loan. The bank agrees to lend them the money, and the family agrees to pay it back every month for the next 20 years. If they stop paying, the bank has the right to take the house and sell it to recover the money. So here are the characteristics of the residential mortgage. First, mortgage interest rates. There are the three important things that affect how much interest you will pay on a mortgage. First, current long-term market rates. These are prevailing interest rates for long-term loans, which directly influence the mortgage interest rate you receive. These are the general interest rates in the country for long-term loans. If the rates are high, your mortgage interest will also be high. If they are low, your mortgage will be low too. Second, term or life of the mortgage. The length of time over which the mortgage is repaid, typically ranging from 15 to 30 years. Longer term usually mean lower monthly payments but more interest paid over time. This is how you will take to pay the loan back, usually 15 to 30 years. A longer term means smaller monthly payments but will pay more interest overall. A shorter term means higher monthly payments but you will pay less interest in the end. And the last one is the number of discount points paid. Discount points are upfront fees paid to the lender at closing in exchange for a reduced interest rate. 1 point typically equals 1% of the loan amount. These are extra payments made at the beginning or closing to lower your interest rate. For example, 1 point is equal to 1% of the loan amount. The more points you pay upfront, the lower your interest rate may be. B. Loan terms. The conditions of the loan agreement, including the interest rate, repayment period, and any fees or penalties. These terms affect the total cost and monthly payments of the mortgage. This includes everything written in the loan agreement: the interest rate, the time you have to repay the loan, any fees or penalties if you pay late or pay off early. These details affect how much you pay each month and the total cost of the mortgage. Next, the collateral. An asset, typically the home being purchased, that the lender can seize if the borrower fails to repay the loan. It reduces the lender's risk. This is something valuable that the bank can take if you don't pay the loan. Usually, the house you are buying. If you stop paying, the bank can take and sell the house to get their money back. Next is the down payment. The initial amount paid upfront toward the purchase price of a home. A larger down payment often results in a better loan terms and reduces the loan payment. This is the amount of money you pay upfront when you buy a house. A larger down payment means you borrow less money and may get a better loan deal. Usually, you need at least 10% to 20% of the home's price as a down payment. Next, the private mortgage insurance or PMI. A type of insurance required by lenders when the down payment is less than 20% of the home's value. It protects the lender if the borrower defaults on the loan. If your down payment is less than 20%, the lender may ask you to pay PMI. This is a type of insurance that protects the bank, not you, in case you can't pay your loan. Next is the borrower qualification. The process by which lenders assess a borrower's ability to repay a mortgage based on factors like credit score, income, employment history, and debt-to-income ratio. Before giving you a loan, the bank checks if you can really pay it back. They look at things like your credit score, your monthly income, your job history, how much debt you already have. This process helps the lender decide how much money they can safely lend you. Amortization of mortgage loan. The gradual repayment of a mortgage loan over time through scheduled monthly payments that include both principal and interest. Yearly payments primarily cover interest, while later payments reduce the principal. Amortization means slowly paying off a loan over time by making monthly payments. Each payment includes two parts. First, the interest, the fee for borrowing the money. And the second is the principal, the actual amount you borrow. At the start of the loan, most of your monthly payment goes to the interest. Later on, more of your payment goes toward paying off the principal. This continues until the loan is fully paid. Here are the types of mortgage loans. First is the conventional mortgages. Loans not insured or guaranteed by the government, typically requiring higher credit scores and down payment. There are regular loans from banks that are not backed by the government. You usually need a good credit score and a big down payment to get one. Insured mortgages. Loans backed by government insurance like FHA or VA loans, protecting the lender against borrower default. These loans are protected by the government like FHA or VA loans. If the borrower can't pay, the government helps the lender get their money back. These are easier to get for people with the lower credit scores or smaller down payments. Next is the fixed rate mortgages. Loans with an interest rate that remains constant throughout the life of the loan, offering predictable monthly payments. The interest rate stays the same for the whole loan. Your monthly payment never changes, so it's easier to plan your budget. Next is the adjustable rate mortgages or ARMs. Loans with the interest rates that fluctuate periodically based on market conditions, which may lead to changing monthly payments. The interest rate can go up or down depending on the company. The economy. Your monthly payment may change over time, sometimes more, sometimes less. Next is the graduated payment mortgages or GPMS. Loans with initially low payments that gradually increase over time, designed for borrowers who expect rising income. You start with low monthly payments and they slowly increase over time. This is good for people who expect their income to grow in the future. Next is the growing equity mortgages or GEMs. Loans with fixed interest rate but increasing monthly payments, allowing for faster loan payoff and reduced interest costs. The interest rate stays the same but your monthly payments go up over time. This helps you pay off the loan faster and pay less interest overall. Next is the shared appreciation mortgages. Loans where the lender receives a share of the home's future appreciation in value, often in exchange for a lower interest rate. In this type, the lender gets part of the increase in your home's value. When you sell it, in return, you usually get a lower interest rate. Next is the equity participating mortgage. Loans where the lender shares in both the rental income and appreciation of the property in return for lower interest or other concessions. The lender shares in the rental income and value increase of your property. In exchange, they may offer lower interest or other benefits. Next is the second mortgages. Additional loans secured against a property that already has a primary mortgage, often used for home improvements or debt consolidation. This is a second loan on a house that already has a mortgage. People usually get this loan to pay for things like home repairs or other debts. And next is the reverse annuity mortgages. Loans available to older homeowners that convert home equity into regular income payments, repayable when the home is sold or the borrower passes away. This loan is for older people who own their homes. Instead of making payments, the bank pays them every month. They repay the loan when the house is sold or after the owner passes away. Securitization of mortgages. The process of pooling various mortgage loans and selling them as securities to investors. This helps lenders free up capital to issue more loans. Securitization is a financial process that helps banks and lenders continue giving out loans. Here's how it works. Banks give mortgage loans to many people who want to buy houses. Instead of waiting many years for people to pay back those loans, the bank groups many loans together. Then the bank sells this group of loans to investors in the form of a financial product called a mortgage-backed security or MBS. The money from the sale gives the bank more cash to lend to new home buyers. Mortgage-backed security. A financial product created through the securitization of mortgages. Investors receive regular payments derived from the mortgage borrower's principal and interest. An MBS is like a package of home loans that are sold to investors. When people make their monthly mortgage payments, that money is collected and sent to the investors who bought the MBS. So, investors earn money from the principal and interest payments made by homeowners. Securitization, a financial process where assets like mortgages are bundled together and converted into tradable securities sold to investors. It spreads risk and increases liquidity in the financial system. Why is securitization important? It spreads the risk so that banks don't carry all the burden if people stop paying their loans. It gives banks more money to lend to others. It helps keep the financial system moving by turning long-term loans into investments that can be bought and sold. For example, imagine the bank is like a bakery. The bakery gives out cookies or loans to many people. Instead of waiting years for everyone to pay for their cookies, the bakery bundles the cookies into a big box or a mortgage bank security and sells the box to someone else, that is the investor. That investor then earns money as people slowly pay for their cookies. In conclusion, knowing how mortgage loans work is essential, especially if you're thinking about buying a home someday. Things like interest rates, loans, terms, and how much you put down upfront all play a big role in how much you'll end up paying. These are also different kinds of mortgages, and each one comes with its own pros and cons. We also looked at how mortgages are turned into investments through something called securitization. This helps banks offer more loans, but it can also lead to problems if not handled carefully. In the end, understanding these ideas can help you make smarter financial choices and avoid costly mistakes down the road.